Okay, so we are ready for chapter 16. And there are some notes. They just say like cost CVP equations, so cost volume profit equations. So those are out on Canvas for you to print out, just kind of going over the different equations that you'll use in chapter 16, because we really are focusing on equation type questions, contribution margins, and looking at break-even points and target volume. So we're really looking at everything from a variable costing standpoint now. If you remember that from managerial, if you don't, that's fine. But, you know, like full costing or absorption costing is when we're looking at, you know, your typical sales minus cost of goods sold equals gross profit, and then you take out all of your operating expenses to get to income. So when we're looking more at cost volume profit, when we're trying to make decisions based on pricing and volume and things like that, we're going to look at variable costing models. So how that changes is we're now going to take like sales minus all of our variable costs to get a contribution margin. And then that contribution margin covers all of our fixed costs, basically, or that's the hope, that it'll cover our fixed costs and then we'll still have money left over. So just to kind of give you a background, the chapter doesn't necessarily go into all of that, but that's just the basics of costing. So we kind of looked at that in managerial, and then even in previous chapters, you know, we've done the full costing. So really the hope is here that when we make decisions, we're looking more from a variable cost standpoint, because variable costs, of course, are those that change with increases in production. So those are the ones that are really decision driving, because fixed costs are a little harder to change, right? You know, our factory costs, rent, things of that nature. We have to pay those regardless of whether we produce or sell 5,000 or 20,000. So that's why when we're looking at break-evens and safety rate margins and all of that, we're looking more at variable costing, okay? So just to give you a little background on the why. And we don't get into it in any of these, but it would be the same if we were considering like taking on a special order. If you remember that from managerial, it's like, oh, if someone offers us a special order and says, oh, we can pay you, you know, $2 less per item, but we're going to order 500 items. You know, we would look at just variable costing to make that decision, as long as we weren't exceeding the capacity of our current fixed costs. Okay. So that goes a little bit off, but that's kind of why we do cost volume profit analysis, to make those decisions too. And of course, it's always important to be able to calculate our break even, you know, in both units and then in dollars as well. So that's what we're going to be doing in this chapter, is calculating variable costs and contribution margins. So again, you know, your contribution margin is just the portion of money we have left to cover all of our fixed costs. Okay, so we're going to take a look at some of those. Chapter 16, practice. Oops, I'm in the wrong thing. No, I don't want to assess my knowledge. Okay. Okay. So here on this first one, we're starting out just, again, dealing with variable costs, contribution margins, and contribution margin ratios. So again, contribution margin is always just sales minus all variable costs. So both product and period variable costs, okay? So we have Super Tees Company plans to sell 12,000 t-shirts at $16 each. Direct materials, $5.75. Direct labor, $1.25. which those are both variable costs. And then we have variable overhead of 60 cents. And then they tell us total fixed factory overhead is 43,000. Variable selling expense is the redemption of a coupon, which averages 80 cents per t-shirt, and fixed selling and administrative total 19,000. So in this first one, we're really just categorizing different cost types, okay? So the first one's asking for variable product costs per unit. Okay, so what three costs would be just variable product costs? Very good, because the keyword there is product cost, right? So we just want the variable product. Well, that's materials, direct materials, plus direct labor, plus just the variable portion of overhead, okay? So there we just want our variable product per unit. It's a little bigger here. So what is my variable product cost per unit? You do? Or I do? Did I do something on this one? Does everyone have different numbers? Okay, I was like, giving me a heart attack. I'm like, what did I do? Very good, $7.60. I was going into the adaptive learning plan, so we're just all over the place tonight. Maybe we should have stayed home, right? So yeah, variable product cost per unit, direct materials plus direct labor plus our variable overhead. Okay, so just those three costs. And then on B, it wants the total variable cost per unit. So really there, we're taking that and adding in the variable selling expense of 80 cents. Okay, because the reason we need that is that helps us calculate our contribution margin. So really $7.60 plus the additional 80 cents, so at $8.40. Okay, so that's our total variable cost per unit. From there, we can calculate our contribution margin per unit. Okay, so again, on your notes, you have that contribution margin is truly the sell price minus the variable cost. Okay, and you want to make sure and choose the total variable cost, not just the product cost. So contribution margin is sales minus total variable cost. Okay. So there, our sales price is $16 minus our variable of $8.40. So what, $7.60, right? Same as our variable product cost. That's not always that way. And then on D, it just wants it as a contribution margin ratio. So really, we're just putting it as a percentage. Again, if you look at your notes, for contribution margin ratio, you're taking your contribution margin per unit of $7.60 and dividing it by the sales price of $16. Okay. So to get it into a ratio, you're just going to take contribution margin divided by sales. So what is my contribution margin ratio?
475.
Very good. Yeah, they want it to 3 decimals, so 0.475. So contribution margin ratio is 47.5%, in other words. And then on E, they just want the total fixed expense for the year. Well, we have two fixed expenses. We have fixed factory overhead of $43,000, and then our fixed selling and administrative of $19,000. So $62,000 total fixed expenses. Okay. Okay, so that's just computing those basic things that kind of lay the foundation for this chapter. And then on number 2, they want us to prepare a contribution margin-based income statement. So again, this is more used for managerial purposes. The full costing that we're used to, where we see sales minus cost of goods sold, that is financial income statement. Okay, so that's a full absorption costing. Now we're looking at contribution margin-based. So this is just for internal use for managerial decision making. Okay, so I mean, it starts the same though. You start with sales. Okay, it's just like any other income statement. Okay, and then they want it both total and per unit. Well, we already remember sales per unit is 16, and it told us somewhere we plan to sell 12,000 t-shirts. Okay, so what's our total sales? Very good, 192,000. So 12,000 at 16 each. Again, on a contribution margin based income statement, we're going to then subtract out our total variable expense. Total variable expense. So what is our total variable expense?
100,800.
Very good, 100,800. And we got that the per unit variable was the $8.40 that we already calculated. Okay, so our total variable cost per unit was $8.40. and we just multiplied by the 12,000 units. And then we subtract, and that gets us our total contribution margin. So what, 91,200. So total contribution margin is 91,200. And we already calculated per unit $7.60. Okay. So sales minus total variable expense equals our contribution margin. And then we're just carrying it down, so we're going to subtract out our fixed expenses now. Okay. So minus our fixed expenses. And you can put the minuses in, as well. And we already calculated that at 62,000. 62,000. So we subtract those, and we should get operating income of 29,200. 29,200. And again, it wouldn't matter if we did full absorption costing, we would see the same operating income. It's just putting it in a different format, where we subtract out variable and then fixed instead of taking out product and then period. Okay. And then the number 3 here is just the what if. What if the per unit selling expense increased from 80 cents, so that was a variable selling expense, from 80 cents to $1.75. So we just want to calculate our new costs. Well, would our variable product cost per unit change? No. So it would still be $7.60 because it doesn't have a selling expense in it. What would my total variable cost per unit now be? $9.35. Very good. So in that case, you could just subtract the difference, right? The 95-cent increase and add it to it. Or you could re-add, direct labor plus direct materials plus variable overhead plus $1.75. So total variable cost per unit went up 95 cents. So what does that change our contribution margin to?
$6.65.
Very good, $6.65. So again, we got that by taking $16 sales minus total variable costs. So 16 minus $9.35. And so then what's our new margin, our contribution margin ratio? So 4 decimals.
0.4156.
Very good, 0.4156. Which to get that, we took $6.65 divided by 16. So we're just putting that into a percentage. And then total fixed expense for the year, does that change? Nope. So it's still the 62,000. Any questions on that one? Alrighty. Pretty straightforward, right? It's just looking at things a little differently. Okay, well, let's move to the second one. It's pretty easy too. Here, we're just going a little further from just contribution margin, and they want to know break even, and then we're also going to look at how many units it would take to make a target profit. So, these are good questions to answer, right? We need to know how many units we need to sell in order to break even, and then we can also figure out how many units it would take to sell to make a specific profit. So those formulas, again, are on your little cheat sheet on your note. I can just call them on your note. Good notes. So JZ Company makes an in-car navigation system. Next year, he plans to sell 16,000 units at a price of $320 each. We have materials, labor, variable overhead, and fixed overhead. Variable selling expense is a commission of 5% of price. And then we have fixed selling and administrative of $116,400. So the first thing it wants us to calculate is just the sales commission per unit sold. Okay. Well, they tell us that's 5%, right? So just 5%, bless you, of 320. So what's our sales commission? 16, perfect. So that's our variable selling expense. Okay, so we'll need that to calculate contribution margin. So the next one, it says, calculate the contribution margin per unit. Okay. So on that one, again, we would take our sales price of $320 minus our total variable, which they didn't have us calculate first, right? So we're kind of leaving out some steps. So what is my contribution margin per unit? 184, very good. Okay, and again, whoops, not 94. We get that by taking 320 minus 68 for materials, 40 for labor, minus 12 for variable overhead, and then minus the $16 commission, that variable selling expense. So again, your contribution margin is always sales minus total variable costs. So we would always take out materials, labor, variable overhead, and variable selling expense. And then for break even, well, break even, you always just take your total fixed costs and divide it by your contribution margin, okay? They're looking for in units, and we have a contribution margin in units. So to get break even, we just take our total fixed costs and divide it by the 184. Okay. Well, your total fixed costs, what? 500,000 plus 116,400, right? So you should have total fixed cost of 616,400. And you would just divide that by 184, our contribution margin per unit. Okay. Makes sense, right? Because contribution margin is already taking out all the variable costs. So now we just have to cover the fixed costs. So how many units must Jay-Z Company sell to break even? To the nearest dollar, I think, if it's not. Or unit, sorry. Nearest whole unit.
3,350.
Very good, 3,350. So again, we got that by taking our total fixed costs, the fixed overhead of 500,000 plus fixed selling and administrative of 116,400, and divided by our contribution margin per unit. Okay. So that's per unit. They would need to sell 3,350 units just to break even and not turn a profit. Okay. So they know anything they sell beyond that is pure profit, which is good. So that's important. Then they just want us to prepare an income statement showing that. Again, they don't say it specifically, but we're doing a contribution margin income statement. So you would have sales. And well, sales, they anticipate, well, we need to use the 3,350, right? Because they want it based on the calculated number of units. So they want us to do an income statement showing break even, okay? So it'd be the 3,350 units times the sales price of 320. The sales should be 1,072,000. It's a lot of sales to break even, right? Oh, maybe they need to change their sell price or something. And then we would take less our variable expenses. Okay. So less our variable expenses. Well, there we would have to add up our total variable expenses. Okay. So we would take, materials plus labor plus variable overhead plus the variable sales commission. Okay. Multiplied by the 3,350 units. So what do we get for total variable expenses? Very good, 455,600. Okay. Trying to read off the numbers, right? I think I read numbers in my sleep now. So again, variable expenses, we just added up all of our variable expenses, and you should have gotten $136 per unit times the 3,350 units. And then our contribution margin, of course, we just subtract. So you should get 616,400. 616,400. And then we had fixed expenses of 616,400, which leaves us with an operating income of 0. So that one worked out that it calculated to 0. Sometimes, you know, when you get fractions of units, if you would have gotten like 3350.5, you may not have exactly 0 on this because of those fractions, if they have you rounding. But in this case, we worked out. Any questions so far? Y'all can just tell me if we're going too fast or too slow or anything. On number 3, calculate the number of units Jay-Z Company must sell to achieve target operating profit of $333,408. Well, to do that, you're just going to take your fixed expenses, the 616,400, plus that target income. So add those two together, and then divide by the 184 contribution margin. Okay? So to calculate target profit in units, or target sales in units, you're going to take fixed expenses plus the target income. So the 616,400 plus 333,408, and then divide by your contribution margin. Okay. So how many units would we need to sell to get that target income?
5,000.
Very good, 5,162. Okay. 5,162 units. So it's pretty nice, that contribution margin, right? Once you calculate that, you can then figure out how many units it would take to get to any target income. Okay. On 4, it says, what if the company wanted to achieve a target operating income of 322,000? Would the number of units needed increase or decrease compared to number 3? Decrease. Yeah, we're decreasing our target income, right? So that would decrease our sales. Okay. And then I just want you to compute the number of units needed for 322,000 of target operating income. So how many units would we need to sell to get $322,000? Very good, 5,100. So again, you're doing the same thing. You would take your fixed of 616,400 plus target of 322,000 and divide that by your contribution margin of 184. So that one showed us both break-even point as well as calculating sales for a target income. Any questions on that one? All right. On to the third one. And this one, you know, trying to kind of give you a mix of different questions. So this one, we're looking at after-tax profits. So here, they're wanting us to calculate the before-tax profit to reach an after-tax profit. So here we have Olivia and Company wants to earn $420,000 in net after-tax income. Its product is priced at $275 per unit. We have all of our variable and fixed costs listed, and then we have a tax rate of 40%. Okay. So the first thing it wants us to do is calculate the before-tax profit needed to achieve an after-tax target of $420,000. A lot of words, right? So on your notes, you'll see before-tax profit equals the after-tax profit divided by 1 minus the tax rate. Okay, so we're going to take our after-tax profit and then divide that by 1 minus the tax rate. So we're going to take the $420,000 that we want to get to, and divide it by 1 minus the tax rate. So in other words, 1 minus 0.4, or 40%, you know, 1 minus 0.4. So we're going to divide by 0.6. Okay. So we'll take $420,000 divided by 0.6, which is 1 minus the tax rate. So how much before tax profit would we need?
700,000.
Very good, 700,000. Okay. So there we don't even have to use contribution margin, right? All we need is that after-tax target. So we take that, divide it by 1 minus the sales tax rate. So, you know, they give us the tax rate in a percentage, so just make sure you convert it to a decimal so you can subtract it from 1. Okay, so we would need to make 700,000 before tax to get 420,000. Number 2, part 2 says, calculate the number of units that will yield the operating income calculated in requirement 1 above. Okay. So all they're asking us there is to calculate, you know, the target volume in units, right? So that was just like the last one. When you use the target volume in units, you're always going to go off of the before tax profit. Okay. If you've noticed, we haven't seen taxes in any of our income statements. You know, it's just operating income. So when you're looking at target volume, always do before tax income. Okay. So we would have to calculate our contribution margin, right, to figure all of that out. So this one, even though it's just one little problem, we have some steps to it. So the first thing we're going to do is we need to take total fixed costs plus our target profit. Okay. Well, our total fixed costs, we would have what, 440,000 plus 290,000. So total fixed costs would be 730,000 plus the target profit of 700,000. Okay, and we would divide that by our contribution margin. Okay. We would divide that by our contribution margin. Well, we have to calculate that, right? So for our contribution margin, we know our price was what, $275, and then minus all of our variable. Then we have materials of 90 minus labor of 65 minus overhead, variable overhead of 16 minus variable selling of 14. Okay. So we actually have to calculate the contribution margin. So in other words, you should get what, 1,430,000 divided by $90. Is that what you guys get for the contribution margin? Yeah. So what is the number of units to yield 700,000 before tax profit?
15,800.
Very good, 15,889. Again, here you get a decimal, right? And you have to round it to the nearest. Okay. So they asked us to round to the nearest whole unit. So we would need to sell 15,889 units to get to a before tax profit of 700,000. Okay. And again, it makes sense to round to the whole unit there because we can't sell partial units. But where it throws it off when we do our net income, you're going to see it'll be off a little bit. It won't be a perfect amount because of that rounding, okay? So on step 3, when it wants us to prepare the income statement, again, they want us to do it based on the number of units computed in requirement 2. So we're doing it off the 15,889, okay? Because we want that 420 after tax income. So we're just putting it into an income statement to see that we actually get there. So we start with sales. So sales, 15,889 units times $275 sales price. So sales would be what? 4,369,475. 4,369,475. Our total variable expense, well, we would have to add those up, right? That would be the 90 plus the 65 plus the 16 plus the 14. So if you added up just the variables, the total variable expense per unit is $185. Okay. Times the 15,889 units. So you should get 2,939,465. 2,939,465. And then we subtract to get our contribution margin, which is $1,430,010. So 1,430,010. Total fixed expense, well, we calculated that at $730,000. So we're going to subtract out our fixed expenses, is $730,000. So our operating income would be $700,010. Okay, operating income, $700,010. So again, it's not perfect, right? Because our pre-tax was $700,000, but that's due to the rounding of those units. Then we take income taxes, less income taxes. Well, the tax rate was 40%. Okay, so if we have a 40% income tax, $700,010 times your 40% tax, you should get income taxes $280,004. $280,004. So then our net income, operating income less those income taxes, would be $420,006. $420,006. So again, you know, $6 more than our target income due to the rounding of the units. And then we have a what if. It says, what if Olivian had a 35% tax rate? Would the units sold to reach a $420,000 target net income be higher or lower? Lower, right? Because we have a lower tax. Very good. Okay. And then, of course, it throws out, you calculate the number of units needed at the new tax rate. Always fun, right? So that's a two-step process there, right? We have to calculate our pre-tax income again, or before tax income, and then you calculate the units. So it's kind of longer. It looks short, but then it's really kind of lengthy, right? Deception, deceiving. So we still want the 420,000 after tax, right? But now we're dividing by 1 minus 0.35 because we have a lower tax rate. Okay, so in other words, we're dividing by 0.65. So rounded, you should have a before tax or pre-tax income of $646,154. Okay. So our before tax income lowers to $646,154. Really kind of puts into perspective what a 5% tax increase does, right? And then from there, you're doing your target volume in units. So again, you would take your total fixed costs, which is the same, the 730,000, plus that 646,154. Okay. So take total fixed plus the target before tax or pre-tax income. And then we would divide it by the contribution margin. Has that changed? No, it hasn't changed. So it's still by, I think we said $90. Okay. Okay, so your contribution margin hasn't changed. Okay. So how many units would it take if our tax rate dropped to 35%? Very good. 15,291. So what, almost 600 less units. 15,291. So that's dealing with after-tax profits and also still dealing with target volume and everything. Any questions on that one? All right. On to the next one. This will probably be the last one we do because I realized the last example I have, the only thing that you're doing differently is calculating like a margin of safety. And you guys have that formula, so it's pretty easy. So I figured for time's sake, we can save some time. Maybe get out of here a little early, right? You know, that's never a bad thing. When we're like, we have 30 seconds left. So it's a good way to end the class, you know, on a chapter that's hopefully a little bit lighter, hopefully. Speaking of which, I meant to say this at the beginning. I still will hold class next week. It's just, you know, obviously if you're through with your homework and you're happy, you don't have to come, but we will go over 8 and 16, you know, because that'll be your last exam. We'll be over the last 2 chapters. So if you have questions about 8 or 16 and want to get some help, I'll be here next Wednesday in class, and probably even the next Wednesday, because in case you guys have questions. So, but yeah, that'll really be, I mean, we're really at the ending point. So after this, you'll just have your homework due, and then you'll take your 8 and 16 test. So once you're done with that, and the final's optional, I know I mentioned this before, so as long as you are happy with your grade after you've taken your last chapter exam, you're done. If you're on the border of grades or you missed an exam, you can take the final to replace a low exam and hopefully boost your grade up. So yeah, I'll mention that again next week. But just as a reminder, it doesn't feel like it, right? But now it's like, oh wow, we're almost finished. So yeah, next week I'll still be here. We'll still have class, just kind of review 8 and 16. So if you're struggling with any of it. I know 8 is due tonight, but it doesn't close. If you don't finish it by the end of tonight, it's still open. It was just the due date. So you should still have access to 8 homework, okay? Just in case you're not finished. Any questions on that? I know I just switched gears. So. To think, do it when I'm thinking about it, right? Okay, so let's look at kind of a little different example here, probably the trickier part. Here we have a company that produces and sells 2 products. They have a ceiling fan and a table fan. And they plan to sell 30,000 ceiling fans and 70,000 table fans in the coming year. And then they give us the product price and the cost information below. So for a ceiling fan, we have a price of $60, a variable cost of $12, and then we have direct fixed costs of $23,600. Table fan, $15 price, $7 unit cost, variable cost. Direct, $45,000. And then they have some common fixed selling and administrative expenses of $85,000. Okay, so this is a little different situation because we're dealing with a sales mix. Okay, so when we're looking at this, we just have some different calculations. So I thought we would do this one for sure. So the first one on number 1, it just says, what is the sales mix estimated for next year? Well, when you're doing the sales mix, you're just looking at one-to-one, like fan, ceiling fans versus table fans, their selling ratio. Okay, so we're going to start with that. And as it says, you want to go down to the lowest possible whole number. So when they're talking about sales mix, it's really all they're saying is, again, we're thinking for ceiling fans, they plan to sell, what, 30,000? 30,000. They're selling 70,000 table fans. Okay, so that's your sales mix at its greatest number, obviously. So you're just reducing that down to the smallest whole number. Well, that's pretty easy because they're both in the 10,000s. So we're just reducing that down to a 3-to-7 ratio. Okay, so for every 3 ceiling fans we sell, we'll sell 7 table fans. So that's what they mean when they talk about sales mix. So we have a 3-to-7 sales mix. And that helps us calculate the fun stuff we get to calculate. So on number 2, it says, using the sales mix from requirement 1, we want to form a package of ceiling fans and table fans and calculate how many ceiling fans and table fans are sold at break even. That's fun, right? So I'll show you how to do that. Like I said, this is probably the trickier part. So first, what you have to do is you have to calculate each one's individual contribution margin unit, okay? So we're going to start with that. So we're going to start with the ceiling fan. Okay, well, ceiling fan, the price was 60 and the unit variable cost was 12, okay? They just give us straight up the unit variable cost. So here we can truly just take 60 minus 12, because those are the variable costs. So ceiling's contribution margin, the CM for contribution margin, is 48. Okay, and that's all given up here. So just the price minus the unit variable cost. And I would do the same for the table fans. Well, the table fans have a price of 15 and a variable cost of 7. So they have an $8 contribution margin. Okay, an $8 contribution margin. Well, what we need is a combined contribution margin because they share some fixed expenses. And we know to do break even, we need to take total fixed expenses divided by contribution margin. Okay, so in order to figure out a shared contribution margin, we use that sales mix. So to figure out the package contribution margin, we take them by their sales mix. So for ceiling fans, I'm going to multiply the unit contribution margin times the 3 sales mix. So its package contribution margin is $144. And for table, I'm going to multiply it by the 7, its sales mix. So its package contribution margin is 56. So we have to use a sales mix to find a total contribution margin for the whole package. So I just add those together. So it's a nice even 200. Okay. So that 200 is my package contribution margin. Okay. So that's always the first step. Okay. So we have to calculate the package contribution margin. Any questions on that? Well, once we have the contribution margin, then we just take our total fixed costs and divide it by that, okay? So we just have to make sure we get all the fixed costs. So we have, for ceiling fans, we have a fixed cost of $23,600, plus table fans, $45,000. Plus their common fixed expenses of $85,000. So I would add up all three of those, both direct fixed costs and then their common fixed costs. Okay, so when you do that, you should get a break even in packages of 768. So when we divide that out, our break even is to sell 768 packages. Okay, 768 packages. So now, to break that down by ceiling fans and table fans, we're going to take that package times the sales rate. Okay, so for ceiling, it would be 768 times 3. And for table, 768 times 7. Again, there's just a little more involved work in the package, the sales mix. So for break even on ceiling fans, 768 times 3 should be 2,304. 2,304. And for our table, 768 times 7 should be 5,376. 5,376. I have note on that on the notes. Hopefully it makes sense. When I read it through yesterday, I should have probably changed it. It wasn't, it was like, is that really clear? And then I forgot, so I apologize. Kind of, you know, it's like calculate each unit's contribution margin, which is what we did, and then multiply by the sales mix, which was what we did. I guess that's right. Add them together to get the package contribution margin. And then we take our total fixed cost divided by the package contribution margin. And then we multiply them back by the sales mix. I guess it does make sense if you know what it's talking about. So hopefully it'll help you. So just following that process. So then once we have the break even on part 3, it just wants us to prepare a contribution margin based income statement based on the unit sales calculated in requirement 2. Okay. So here, again, we're starting with sales. Well, we're going off break even, okay? So we would take for ceiling fan sales, $23.04, and the price is $60, okay? So the sales of ceiling fans should be $138,240, $138,240. For table fans, you have 5,376 fans times 15 price. So it should be 80,640. 80,640. There we go. So total sales, just working all the way across, would be 218,880. 218,880. And then we do our variable expenses. Well, the nice one on this is they give us per unit variable expenses. So for the ceiling fans, we would take a $12 unit variable cost times our $23.04 ceiling fans. So that would be $27,648. $27,648. For table fans, we have the 5,376 times a $7 unit cost. So 37,632. 37,632. So total would be 65,280. 65,280. Then next we do our contribution margin. So for ceiling fans, you should get 110,592. 110,592. Table fans, when we subtract, we get 43,008. So 43008. And for our total, should be 153,600. 153,600. Since we have a package here, the next thing we're going to do is take out the direct fixed expenses. So less the direct fixed expenses. Well, those were given. So for ceiling fans, it was 23,600. 23,600. Table fans was 45,000. 45,000. And our total was 68,600. 68,600. So the next line is your product margin before we take out any common expenses. So product margin for ceiling fans, 86,992. 86,992. And on your table fans, if you notice, it's actually a negative, right? Our product margin there is actually a minus 1,992. So our contribution margin did not cover all of our fixed. And then our total product margin, though, is 85,000. 85,000. And then we subtract out our common fixed expenses, which are also 85,000. So we arrive at operating income of 0. Okay. So of course, from an analysis standpoint, I would probably look at a different mix of ceiling fans to table fans, or change something with my table fans to get a positive product margin there. You know, that's obviously this is break even though for the total, so that's why, you know, it gets a little different. Okay. But again, you know, your ceiling fans have a much higher contribution margin. And we don't get into that in this chapter, but you know, the higher contribution margin of a product, if we have the capacity, we should probably be producing, if we can, and selling more ceiling fans, right? It makes sense. So that's kind of the reason we do a lot of these analyses, so we can kind of identify that, because if a product has a higher contribution margin, we're getting a higher return from it. Okay. So again, that depends on sales. Maybe more people buy table fans because they're cheaper, so we may not have the ability to sell more, but we would look into that. Okay. We have a what if, don't we? Of course we do. Just when we think we're finished. Oh, what if we wanted to earn operating income equal to 14,400? Calculate the number of ceiling fans and table fans that must be sold to earn this level. Okay. So on that one, it says hint, remember to form a package. Well, we've already done that. So we can still use our $200 package contribution margin. So the good news is all you're doing or changing here is you're adding in that target profit. Okay. So to change that for target income, we're taking our total fixed and adding in the 14,400 of target income. So thankfully it's not super long. We're just changing that break even into a target income. So you should get, in this case, 840 packages. So again, for ceiling, it would be 840 times 3. And table fans would be 840 times 7. Okay, so at least it's not a super long what if. So your break even for your ceiling fans should be 2,520. And for table fans should be 5,880. And they're saying break even, but that seems like a typo there. That should be your, that's to achieve a target income of 14,400. So it's really not break even in that case. So again, all we had to manipulate was adding our operating income, our desired income, into our formula to get a new package mix. Any questions on any of that? Again, we'll skip this last one. You're still going to be calculating contribution margin and break even, which we've done, as well as operating income. The only difference is you're going to do margin of safety in both units and sales revenue. But again, those are on here, so it's pretty easy to calculate. Margin of safety is just your sales volume minus your break-even sales volume. So the margin of safety is just what you've sold beyond break-even, okay? So you're going to do that both in units and sales revenue. Well, once you have it in units, just take it by the sales price. That gives you the sales revenue, okay? So that's pretty easy to convert there. Any questions on chapter 16? Okay, well, like I said, we'll get out of here a little bit early, about 15 minutes early. So again, next week, feel free to come and bring questions over 8 or 16 that you have, and we'll just kind of go over any lingering questions, and then you'll just have your test. So I think that's everything. We got our project done in the first part, so yeah, your homework for 16 is due next week, and then you'll have another week to do the exam 3. And then after that, it's just the final exam, which is optional. So if I don't see you past this, I hope we've had a good semester.